What's up, everyone? In today's video, we're talking about why you shouldn't keep all your cash in the bank. I know that might sound crazy, since we're always told the bank is the safest place for money. But the truth is, there are a lot better places you could be putting your cash these days. Stick around, because I'm going to share 6 different assets that will keep your money safer and help it grow way more than any old savings account. First up though, let's talk about the risks of keeping cash in the bank. Now don't get me wrong, the bank is great for basic things like checking accounts and short-term savings. But parking too much money there long-term can actually put your finances at risk in a few key ways. For one, banks charge fees out the wazoo. Account fees, ATM fees, overdraft fees, they add up fast. Plus, there are taxes on the interest you earn, steadily chipping away at your balance. Also, inflation is constantly reducing the value of your money. As prices rise over the years, your dollar buys less and less. Leaving big stacks of cash in a basic savings account won't counteract that. And with interest rates so low right now, you're looking at a tiny return. We're talking 0.01%, not even enough to keep up with inflation. So your purchasing power still goes down. The bottom line is cash parked in traditional bank accounts is losing value year after year. You've got to put that money to work somewhere it can actually grow and compound. Now let's get into the good stuff. 6 assets way better than cash. Asset 1. Precious metal sup. First, precious metals, specifically gold and silver. Now these have been solid investments for thousands of years, long before stock markets and cryptocurrencies existed. Investing in precious metals has historically been a great hedge against inflation. As prices rise over time, gold and silver tend to retain their value much better than dollars sitting in the bank. Metals also help diversify your investments away from just stocks and bonds. And unlike paper money, they have inherent tangible value. Gold and silver will always be in demand, even in economic downturns. The supply is also limited. No government can just print more like they can with cash. Gold and silver maintain their scarcity. Now, precious metals investing does have some downsides to consider. For one, metals don't provide any passive income like dividends or interest. And they can fluctuate in value week to week, just like other assets. Storage and security also has to be considered when stockpiling physical metal. But overall, allocating a portion of your portfolio to gold and silver can really help offset inflation and protect your wealth in the long run. ETFs and mutual funds offer easy access these days without needing to actually store bars of bullion. Asset 2. Real estate. Next up, real estate. Property has long been one of the best investments for building lasting wealth, and a great way to get your money out of low-yield savings accounts. Unlike cash, real estate tends to appreciate steadily over decades and keep pace with inflation. At the same time, rental income can offset your expenses and keep cash flowing in each month. Owning property also allows you to build equity, as your mortgage principal payments increase your ownership stake over time. Plus, there are tax perks like writing off expenses against your rental income. Real estate does come with responsibility as a landlord, and it's not as liquid as stocks and bonds. But overall, it's an excellent asset class for investing capital outside of the bank, allowing you to diversify into hard, tangible assets. Asset 3. Stocks. Now, stocks might seem riskier and more volatile than bank accounts, but in the long run, they've proven to be one of the best places to grow your money. Historical average returns are around 10% per year, way better than the interest banks pay. Owning stocks gives you a share in the upside as companies expand and increase profits. Stocks also provide passive income in the form of dividends. Many established companies pay shareholders quarterly dividends just for owning the stock. It's like getting interest payments, but often with higher yields. And while they fluctuate wildly in the short term, over decades stocks have positive growth. Diversifying your holdings helps reduce the bumps in the road and takes advantage of compound growth. Now, personally, I like indexes for beginner investors. They provide instant diversification at low cost, but individual stocks can be great too once you build up your knowledge. Asset 4. Bonds. If you want to low risk but still earn more than cash, bonds are a great option. Government and corporate bonds provide very stable passive income in the form of fixed interest payments. So while rates are lower than stocks, you get predictable returns, usually between 3 to 5% annually. No worrying about share prices swinging up and down. Bond prices also don't jump around like stocks, so you don't have to constantly monitor your holdings. The relative stability of bonds offsets risks when combined with riskier assets in an overall portfolio. There are different types of bonds with various risk/reward profiles, but in general they are very low risk compared with stocks and real estate, and light years ahead of cash for earning consistent returns. Asset 5. Cryptocurrency. Next we come to cryptocurrency, basically digital money secured by encryption. This includes coins like Bitcoin, Ethereum, and thousands of others. Crypto is the newest asset class on this list, so the long-term profile is still uncertain. But potential upsides include breakthrough tech, decentralization from banks, anonymity, and huge growth potential as adoption increases. With crypto, you become your own bank, controlling your money digitally and transacting directly with others. Cutting out middlemen keeps fees extremely low, maximizing your capital. Now, crypto does come with plenty of volatility and risks compared to traditional assets. There are still unknowns surrounding regulation and real-world use cases. Lots of research is needed if you decide to dip a toe into crypto. Only invest money you can truly afford to lose. But many believe this asset class could be as game-changing as the internet. Plenty of room for upside if you take calculated risks and hold long-term. Asset 6. Collectibles. The final asset group I'll mention is collectibles, like artwork, vintage items, memorabilia, rare coins, etc. Although less accessible than financial instruments like stocks and bonds, collectibles have been an attractive option for certain investors for generations. Scarcity and limited supply drive up values over time, and values aren't necessarily tied to business cycle fluctuations like stocks. Supply and demand, along with cultural significance, dictate prices. Collectibles also provide an inflation hedge and diversification for your portfolio allocation, with the potential for strong gains. Of course, you need specialized expertise. Getting scammed is a big risk as a novice, but judiciously investing in rare tangible items like art and antiquities can really diversify your holdings away from flat cash in the bank. Wrap up, diversify your assets. Phew, we covered a ton of ground looking at alternatives to stockpiling cash in low-yield accounts. As you can see, there are plenty of options, traditional stores of value like gold and real estate, as well as new emerging asset classes like crypto. Each investor needs to consider their own risk tolerance and preferences when deciding how to allocate away from cash. Seek professional financial advice if needed to customize your own diversified strategy. But the key point is that letting large amounts of money waste away in checking and savings accounts is risky in its own right, due to inflation and lost opportunity costs. If you've got extra cash laying around, put it to work across a variety of assets to maximize your wealth and take your finances to the next level. Thanks for watching, and I'll see you in the next video.